Welcome back. Let's talk about the markets, the way forward, individual stocks and investment opportunities. Pankaj Murarka, founder of Renaissance Investment Managers, is now here with us on the show. Pankaj, morning and thanks for joining in. One of your top holdings is Bharti Airtel. Now, we've seen renewed aggression from Reliance Jio in the postpaid segment, now in the broadband segment as well. Plus, expectations of a tariff hike have been pushed forward now. Many people on the street are saying it's going to happen post-general elections. Again, negative for the telecom space as well. Given what we are seeing of late, Reliance's aggression, Jio's aggression, would you still keep the faith on Bharti Airtel? And what is the investment thesis for you?
Good morning, Rima. I think our view on telecom is slightly more medium to longer term. To put this in context, telecom in India used to be an industry which was extremely fragmented, and it was an industry with 15 players. What we essentially seen post the onslaught of Jio is it's an industry which has become oligopoly. Globally, across industries we have seen over the years, oligopoly industries tend to have very strong pricing power. And in India, telecom is still a growth industry because data consumption has grown exponentially over the last 6 years. And with the impending launch of and proliferation of 5G, probably it will again double over the next 4 years. So for us, telecom is a classical industry which is high growth. You don't get high growth in utilities globally so easily. And despite being utility, which is stable business with stable cash flows, it's an industry with strong pricing power. The competitive plan with Jio's launch, I think these are more short-term measures, but the fact is medium to longer term, I think the industry has very strong pricing power. While price hikes have got delayed by a few quarters, we think it's definitely happening towards the middle of the year and probably will continue to happen because telecom companies will keep taking price hikes because the fact remains that the pricing in India is significantly low as compared to any other part of the world, which effectively means that our view, telecom companies in India, which essentially is both Jio and Bharti, will continue to clock high teens kind of EBITDA CAGR over the next actually 10 years. So we continue to remain very positive on the sector and essentially positive on both the names for that matter.
Okay, got that. Pankaj, you do seem to like banking and financial services. I think that in your fund is one of the key sector overweights. There's been a lot of chatter about perhaps margins coming off specifically for banks. Is that a concern for you? Incrementally, are you looking to add more?
So we have a fair exposure to the sector in that sense, and our faith or conviction remains in the sector. I don't think so margin compression is at all a concern for the sector because in fact, historically, banks tend to enjoy the best pricing power in rising interest rate environment because the demand for funds continues to remain strong in that kind of environment, and that is what exactly we are witnessing. So we think, given the strong demand for credit, banks have strong ability to pass on any hikes in the deposit cost very comfortable to the customers, and we don't see that as a concern. The good thing is asset quality amongst large banks in India remains one of the best that we've seen in the last 10 years. And as we are seeing very strong credit growth in the ecosystem, and which we think will sustain over the medium term because of the revival of private capex, which was missing for last almost 10 years, and public consumption continues to remain strong. Combination of all of this and reasonable valuations effectively makes the sector a reasonably attractive bet because the sector, at least the top 5 banks in the sector, will continue to report high teens kind of earnings growth with very healthy ROEs and very superior asset quality on the balance sheet. So we continue to like the sector, and especially the larger banks within the sector.
Okay, got that. That is on the banks. By the way, the banks are seeing quite a recovery right now as well. It's around 74 points higher right now for the Nifty Bank, and that's what's really helping the market also recover around, absolutely at the flat line for the Nifty right now. Check out the move that we're seeing in ICICI Bank. It is at the high point of the day. You have the likes of IndusInd, HDFC, which are also supporting the market. So do keep your eye out on the banking pack. The Sensex has moved into the green now, around 65 points higher. Pankaj, but I was looking at some of your other top sector weights. You also have IT, which factors in that list. In this kind of situation where we're seeing so much turmoil in the global markets, do you still keep the faith in IT, or would you choose to perhaps trim positions at a time like this?
No, not really. While we have some exposure to IT, but actually our positioning has been, we've been underweight IT services company for almost now last 15 months since January of last year because of the impending fear of recession in US and the rub-off effect it can have on the valuations of these companies. And also the valuations in the sector were a bit stretched at the start of last calendar year. But now, after 15 months, we think valuations really have come up by 25 to 30% in the sector, so they've become far more reasonable. More importantly, now, in all probability, it looks like probably the impending recession in US will be more like a shallow recession. And our conversation with these companies, and in turn, the feedback these companies share in terms of their conversation with their customers, it seems that global customers, are very committed to the IT spends, and they are not looking to cut down on spends because digital has become very core to global top 2000 or the Fortune 2000 companies. So we don't anticipate any meaningful impact of slowdown in US on the business of IT companies in India. And in fact, if at all anything towards the middle of the year or later part of the year, we'll be actually looking to add on to our IT exposure, where we've been underweight now for over a year now.
Fair point. Pankaj, what's happening with the broader markets over the last 2 days? Do you have a lot of HNIs, ultra HNIs as your clients? Are they actively pulling money out of equities to park their money in debt mutual funds and insurance products before the tax window comes to an end on 31st March? Is that something that's happening?
Well, we haven't seen those kind of movements because our clients are fairly nuanced in that sense, and they're committed equity investors, and the asset allocations are fairly well defined. But I think some of those things are happening at the industry level in terms of clients making shift and probably trying to be more opportunistic given this whole sudden change in tax structure for debt mutual funds. Having said that, we're still advising clients that while debt might look somewhat attractive in the short term because of the higher yields, but the fact remains is that over a 1 year or 2 year or 3 year horizon, we firmly believe that equities will deliver returns which will be far higher than fixed income. Bear in mind, 15 years back, interest rates in India were 10-11%. And even in that kind of environment, equities have always delivered returns higher than fixed income. So fixed income is not a substitute for equities, though clients should have a reasonable exposure to fixed income based their asset allocation, but it certainly cannot substitute equities.
Okay, all right, Pankaj, we will leave it then on that note. Thank you very much for